Welcome to another edition of Around the Table with Stacy Smith. A happy Valentine's Day to you, a day symbolic of love and friendship. But just how much love is there right now in the economy and the markets? Americans aren't feeling that much love, especially in their pocketbooks, as they are facing the highest rate of inflation seen in 40 years. So what effect will this high inflation rate and predicted moves by the Fed to try to counter these high rates have on the economy and for you as an investor? Well, to talk about that, I'm going to introduce you now to our panel of strategists and analysts who can give us maybe a better insight as to what can be done. I would like you to meet Kim Forrest. Kim is the Chief Investment Officer and the founder of Boca Capital Partners. Kim has a duo background in both finance and in software engineering. You may have seen Kim in her many appearances on CNBC, Fox Business, and on Bloomberg. As we go around the table, we find Frank Persetti. Frank has been advising clients in the Pittsburgh region for 50 years. Frank helped to establish Harvest Financial, where he is the executive chairman. And two of my regular analysts and strategists are not with us today. So sitting in for Carrie Coghill is someone who is well-versed in the field of financial advising, and that is Shana Bielik. Shana is the vice president and financial advisor with Coghill Investment Strategies, which of course is based here in Pittsburgh. And standing in today for our regular panelist, Bob Fergasso, is Michael Godwin. Michael has a solid career in investing and is the Chief Investment Officer for Fergasso Financial Advisors. So to Michael and Shana, thank you for joining us for Around the Table. I'm happy that you're able to join us. And of course, to Kim and Frank, our regulars, thank you for joining us once again as well. So let's try to just dive right into this if we can. A moment ago, I mentioned that the most recent report on inflation shows it has not been this high in 40 years. As we have talked about for several months, the Fed, in all probability, is going to raise interest rates to try to counter inflation. Now, we can add another troublesome aspect, and that is a possible war between Ukraine and Russia and what that will mean to Europe. So, Frank, I'm going to begin with you. Inflation, rising interest rates, and possible war. Is this still a case of just holding steady as an investor?
Stacy, as you know, it's rarely a good idea to hold steady. The markets are usually dynamic, and especially so these days. An investor should continuously be evaluating their strategy and contemplating the risks that their portfolio contains. The relationship of components, stocks, bonds, international, small cap, large cap, et cetera, are always changing. These changes alter the risk one is taking. At times, that risk becomes dramatically changed, and the strategy is no longer suitable for what the investor is trying to achieve and their concerns.
Kim.
So if you mean by hold steady, meaning keep your money in the market, absolutely. You may want to rejigger things around if you're heavily exposed to one industry or one area of the world, but these things will pass, believe it or not. And you should never go to cash. Can we talk about that? Just never do it. Never go all cash, never go all in, be somewhere in between, and you'll be just fine.
Michael.
Yes, Stacey, I'd say making portfolio decisions based on geopolitical headlines is not investing. That's trading. And investors have zero edge in trading on Fox News or CNN headlines. And we've always kind of advised against doing that. Now, the inflation and interest rate dynamics are a different story, as both of those can have significant impacts on company earnings, which in the long run is what drives stock market performance. So I think making tactical decisions based on economic data can be meaningful.
All right, Shana, your thoughts.
There will always be something to watch, whether it's interest rates or recession or war. But this is why we work to stress test our portfolios for a range of outcomes to help give our clients the peace of mind to know that they can stay the course and this too shall pass.
All right, great. Kim, let's talk a little bit more about inflation if we can. It seems to have been started by COVID. As businesses shut down because of the virus, a lot of money was pumped into the economy by the Fed to try to prop it up. And the supply chain also, though, has been a problem because it's been slow to recover. The Wall Street Journal reports its analysis of 280 companies that reported quarterly earnings by February the 4th. Out of those 280, 79% had some discussion about inflation in their conference calls. So, Kim, how much of a problem and threat really is inflation.
Well, I think inflation is always a threat, and you always have to keep an eye out for it. But I have to tell you, I'm going to have a non-consensus view here that this inflation was not caused by the Fed, and the Fed raising interest rates won't really affect what the inflation that we're experiencing. It's going to have no effect on it. It was really caused by the shutting down of our economy and the kind of bad restarts we keep having, supply chain issues, but also an unbelievable amount of money that went into the system through federal programs. So that is fiscal spending, not monetary. And to try to address this kind of inflation with raising interest rates might push us over into recession. So I think we have to be really cautious about what we are seeing and the remedy that we are calling for, because I cannot sign on that the Fed increasing interest rates is the thing that's going to make my groceries not cost as much. Now, housing rates, the market, those are exactly the things that the Fed was propping up. But we saw this in the last time we had a monetary stimulus in 2008, 2010, and it did not cause this kind of inflation. This time it's different, and I think the Fed knows this.
Michael, your thoughts?
Yeah, Kim brings up a great point there, because I do agree with her in terms of the Fed not really being the catalyst that's caused inflation to be this high, or the highest it's been in 40 years. But I do think that, to your question earlier, Stacy, if inflation does continue to rise, that could certainly be a huge problem. But our baseline forecast is that inflation will begin to moderate in the back half of the year. And we think it should settle in at around 3%, but certainly the risks are biased to the upside there. And the reason that persistently high inflation could be a serious problem is because we believe that economic growth is set to slow in the second half of the year. And slow growth coupled with high inflation is really what's called stagflation. And historically, that has not been a great environment for strong equity returns.
Shana, do you have these same kind of concerns?
I do. This rise, it may be temporary, or at least in the areas of supply chain, as Kim had mentioned. Last week, if we look at a port in Southern California, they had 78 container ships in port, but that was down from 109 the month prior. So this could mean that we are nearing the tipping point of inflation as it at least relates to supply chain. And I echo what Michael said about, Chairman Powell said that inflation will ease throughout the year. So, you look at something like car prices that are up 40%, like how much more can they really go up?
All right, Frank, wrap it up for us.
Sure. Part of the reason we have this inflationary situation is a large number of people have decided to leave the workforce. They've decided they can afford to not work, and potentially this level of inflation will cause prices to rise enough that they will rethink that supposition that they can't work and decide they have to go back to work because things cost more than they thought. And that will in itself also put downward pressure on the inflation that we're seeing. Now, will prices go back to where they were 2 years from now or 2 years ago? I highly doubt it. But going up a lot from here, I would be surprised if that happens.
Do most of you agree with the Michael's assessment that we're looking at more of a short-term aspect as far as how long these high rates of inflation, 7% or higher, are going to last?
I do. And I have some data that just came out of the New York Fed this morning. So inflation is an expectations game. If people expect inflation to keep growing, oddly enough, they get what they expect. And just this morning, both the short term and the intermediate term, so that's a year and 3 years, the Fed is reporting that their survey of consumers is showing a very sharp drop. So it looks like the consumers understand where this inflation came from and how it's going to resolve. So that's really good news for people who are looking at the more behavioral economic side of inflation.
So that means that the need for the Fed to be as hawkish as they've been sounding lately, and hawkish means they're going to raise it. Goldman Sachs says 7 times. Bullard, the president of the St. Louis Fed this morning, sounded as aggressive as I've heard a Federal Reserve person sound without saying anything, because they rarely say anything substantive. But he was aggressively touting that they've got to slow things down. And I think that that'll be true until they slow things down.
And slowing things down is a natural impediment to higher inflation. So with an economy that's likely to slow certainly on the backs of the Fed raising rates, fiscal stimulus that Kim pointed out is sort of nearing the end there. Those are natural, I don't want to say deflationary events, but that should certainly slow the impacts of inflation as we move forward into 2022.
You know, Stacy, a lot of this inflation was caused like a pressure cooker from pent-up demand that was created during the COVID shut-in time. People were sitting at home, not really able to do many things that they like to do. And the demand was pent up. And a year ago, we started releasing people into society again. And that demand pushed prices, created a demand pull along with the cost push created by higher wages. And that demand is starting to peter out. They've done what they wanted to do and didn't do. And we'll get back to more normal spending patterns, whatever that means. It's probably changed as a result of COVID, but that remains to be seen what that means.
You all may have touched on this, but I'll go ahead and ask it anyway. As inflation rises, or it's higher than it has been, and Kim, your comments about what the New York Fed had to say today, will inflation just come down on its own because people stop spending because they can't afford it?
I think so. People just have the concept of enough. Like, am I going to spend X amount of dollars on a car? If it's over what I want to spend, really, maybe even 10% more, everybody has that wiggle room concept. So I think that really does put a chill on things. The only things we can't do are, we have to have some food to eat, right? But we can choose within that basket what we're going to spend and what we're going to spend it on. Shelter and clothing. So those are the basics. And we all kind of pull back and say, enough. I don't need that next thing because it's just too much.
Yeah, it's the old supply and demand thing, I guess, is really what it boils down to. Yep. Shana, and Frank just talked about this, but Shane, I'm going to ask you. Just a couple of weeks ago, the speculation was the Fed might have to raise interest rates maybe 3, maybe 4 times this year. Now, as Frank mentioned, Goldman Sachs is talking about raising interest rates 7 times this year. And one Fed governor said he sees rates going to 1% from 0 as they stand right now by midsummer. So what are you telling your clients right now, Shana?
Well, there's certainly a lot of chatter out there, whether it's 4 times, 5 times, 7 times. Well, we're telling clients and we're reminding them that a rising interest rate environment is actually a good thing. It means the economy is doing well. What we're watching is the pace of these increases. Rising rates too far, too fast could certainly push us into a recession. We have to trust that Powell will continue to watch the data. And really the bottom line is that although this time may be different, we have survived previous rate hikes and we will survive this one as well.
Michael.
Yes, Stacy, I think given the interest rate environment we've been in for a few years now, we've been talking with clients about really kind of repositioning their fixed income portfolios we've been doing that for a few years now. And we think that traditional bonds should still play a key role in many accounts, but in order to generate some semblance of return while also diversifying from equities, we think investors should also look to invest in more niche areas of the markets. We've been pushing our clients into private real estate and private credit, where we think the dynamics are certainly a lot better there. And though we don't think there's much of a chance of the Fed raising rates 7 times this year, I agree with Shana in that moving towards a more normalized interest rate environment will certainly be good for the bond markets and the overall economy longer term.
And if you look at higher interest rates in the retirement community, which is growing as a percentage of the population, higher interest rates means retired people have to take less risk to generate the cash flow they need to live on, which is in fact a good thing.
Kim.
I agree with I don't have anything to add. I'll put it that way. How about that? Sorry.
That's
Enough has
okay.
been said.
Enough of that one. Okay. Michael, many times on this program, Carrie and Bob and Kim and Frank have said to look for opportunities to invest in stocks. This past week, more stocks declined than advanced in all of the major exchanges, and the number of stocks setting new lows were 3 times greater than the number that were setting new highs. So, is this one of those times to jump in?
Well, I think with the Fed set to raise interest rates most likely next month, we certainly anticipate more volatility ahead. And what I'd say here is you shouldn't invest in a stock just because it's gone down. But certainly, I think you mentioned Bob, Kim, and Frank. I think they're all correct in that volatility begets opportunities. So what I would do, I would look at the current environment that we're in and likely to be in over the coming quarters and make investment decisions based on that. So with economic growth likely to slow, in conjunction with Fed rate hikes, we believe you want to move up in quality and reduce your exposure to some more cyclical names, meaning stocks that typically do well coming out of a recession and in the early parts of the economic cycle. And I think I'm not going to give any particular names. I think in aggregate here, I'd say you want to be underweight small cap value here and look to increase your exposure to quality or companies that can still generate revenue growth at this point in the cycle.
Okay, I'm going to before everybody else jumps in, I have to ask this question. How does a typical small investor figure that out on their own? How do they know which of these companies or sectors are going to come out of a recession better than something else, or out of a higher interest rate situation as we're in?
Well, Stacy, I mean, I think I can speak for probably everybody in this panel. I mean, that's what we do. That's something what I do for a living. My entire day is spent analyzing, researching, and understanding the macro environment we're in. And I know Kim very well, and that's what she does on the individual equity side here. So it's hard to do that day in, day out, particularly when you have a full-time job in a completely different industry. So I'm not advocating for our business really, but I'm saying if you want to do this on your own as a small investor, it takes a lot of time. It takes a lot of discipline and it takes a lot of homework. I think the hardest part about all of this in general is trying to take emotion out of any sort of investment decision that you make for your portfolio. And I think that's what, probably the 3 of us or 4 of us on this call really try to excel at with our clients, is really trying to remove emotion and look at the data as opposed to anything else.
As this market gets wild the way it has, we spend a lot of our time talking people off the ledge.
Mhm.
To not overreact, patience, just relax. As many have said today, this too shall pass. I like to hear, somebody once said to me, there's 4 words that are always true. Kim, you'll like this: buy low, sell high. There are 4 words that are never true. It's different this time. All right. I've been doing this for 50 years, and those words are never true.
Shana.
Well, I do agree. I mean, we're here to kind of hold clients' hands. And, we did this in March of 2020. Let's not forget. Let's take clients back. That's where I mentioned earlier that stress testing is really important. And for those clients who aren't working with a financial advisor, hopefully they're working with good companies like Vanguard or Fidelity and have more balanced or blended portfolios. And, we're all here advising clients and investors you're in it for the long term. So this too shall pass.
And Kim.
And as somebody who has looked at individual securities and strongly believes in individual securities, there's a lot going on that you have to understand, not just about an individual name, but their position in the industry and their position in the food chain, about where they are in their life cycle, how management is constructed, if they're any good. I could go on. And actually, I could probably teach a couple of classes on this, but I'm not gonna, because I'm a little busy at my day job. And that being said, there are a lot, if you want to season your investments with a few stock picks, that's better than trying to make your entire portfolio into individual stocks if you're a retail investor.
One of the reasons I bring this up about the small investor, maybe I should clarify this a little bit more, and this is maybe a topic for another day, but a lot of people are invested through their 401ks, and they are somewhat limited as to what they can or can't buy, depending on what the 401k program is for any individual company. So when I ask these questions, I'm kind of also gearing it toward that type of person, because they can't put that money over into under your jurisdiction to help them right now. So how do, what does the 401k person do?
Well,
I think
the 401, sorry, Kim.
no, go.
So in the 401k world, there are generally enough underlying asset classes to choose from. So you, as even a smaller, unsophisticated investor, can come up with a suitable recommendation. But then again, there's also target date funds that align with your retirement date. So it could be as simple as just choosing a target date that aligns with your retirement date and let that do the work for you.
Any other comments?
The great thing about the 401k component is you are constantly dollar cost averaging into the markets. Every 2 weeks or however you get paid, you're always kind of buying in, regardless of whether the market's up or down. And over time, that should smooth out a little bit of the volatility we see in the markets. So I like that component of the 401k aspect for sure.
Good
And
point.
as a commercial for all three of us that help people with their money, we advise people on their 401ks every day. That is sometimes a major piece of someone's assets, other times not. And some of us try to figure out how to get paid on it. Some of us don't care because we're going to get paid anyway. And it's just something we do. I mean, from talking with all of our groups over the last few months, there's no question in my mind that we're going to say, oh, we don't talk about that.
Right.
And the final comment I have is understand where the 401k is going to fill the hole for your cash flow. But the thing that I see most, at least from my friends, and maybe that's because they're a lot from technology, right? They are great savers, but bad investors. And by that, I mean, they're young and they're putting it all into bonds because they don't want to lose the principal, right? No, you must take risks when you're younger, when this money is further away from being used. So know that maybe not investing in a more growth-oriented way might harm you in the long run, depending on your age and your time to retirement.
All right, we have time to get into one other topic here, and it goes back to interest rates, but this time affecting the housing market. As the Fed raises interest rates or even talks about raising interest rates, mortgage rates have been going up. So the question on this particular thing is, what is this going to mean for the housing market if mortgage rates continue to go up? Michael, I'm going to start with you.
Sure. It's a good question. The housing market, the way I look at it, it's a very good barometer of economic activity. In fact, it can often be seen as sort of the leading indicator of leading indicators, which really shouldn't be a surprise given how much housing contributes to GDP. And we gotten to a point, Stacy, certainly since the COVID pandemic, where a huge cohort of certainly first-time buyers have almost been priced out of the housing market. And I think with rates going up, that should help level off how much real estate prices can go up. But make no mistake about it, we've had a supply glut since the end of the financial crisis more than a decade ago, where there's just not been enough supply to keep up with demand for new housing. So it can have the adverse effect of, with mortgage rates going up, you might actually see more temporary demand for getting into new houses because new home buyers or home buyers don't want rates to go up even further and get priced out of a home even more so.
Frank.
You also have to recognize, as Mike says, we have had an inadequate supply for decades. We haven't been building. Add to that the lack of mechanics, tradesmen, carpenters, plumbers, electricians who actually build these things. This supply shortage is not going to go away quickly. So the prices of homes are going to continue to be firm at worst and rise, maybe firm at best, rise at worst. All right. And people are going to be recognizing this, are going to be wanting to buy homes. And the building community is going to have to maybe build smaller homes. We didn't move in, Stacy, you and I did not move into 5,000 square foot homes right out of college. I mean, I moved in an apartment for a while and then built a home. It was around 2,000, 2,400 square feet. All right. Back in the day. All right. When, if I told you what I paid to build it, you young people would all say, what? And, but not long after that, we were dealing with interest rates of 12 and 13 and 14% on mortgages, which no one's talking about interest rates going to that level, because inflation isn't 12 and 13% the way it was then. That 40 years ago they're all talking about. We were talking about 12% inflation. This is 7 and maybe peaking.
Shana.
I really do think that, yes, there's supply shortage, but I do think that demand will still be there even in a higher interest rate environment. Let's not forget that mortgage rates are still relatively low year over year. Yes, last year was a 30-year at 2.75, and today it's at 3.4. That's still relatively low if you're talking about the environment that Frank's describing, when 1980-81 rates were 16 and 18%. So I think that we just really need to stay focused that they are still relatively low.
All right, Kim, if you can wrap it up quickly.
And finally, I think this really shows you what the Fed has to, the tightrope the Fed has to walk. They have to make sure that they need to cool down this market without killing it. And I think that's really, really key. And that's why I'm thinking that we're going to stay in what I consider a low interest rate environment, meaning the 10-year federal bond to be way lower than 3%. For the foreseeable future, for many reasons, but housing is one. People don't necessarily buy houses based on the house price. They're looking at, can I handle the interest rate payment, or can I handle the mortgage payment and the taxes? That people work on a cash flow basis mostly on these decisions between houses and cars. And the Fed knows that, I believe, and they know that they have to keep interest rates relatively low. That's why these kind of hyperbolic 7 interest rates and, it's going to hop up to 1%. I just can't see it. I can't.
Okay, great. I want to thank all of you for this part of our discussion, but now it is time for us to check in with Kim to find out her latest stock suggestions. And before we hear from Kim, I want to stress, as I always do, that under rules and regulations of the SEC, Shana, Frank, and Michael are not allowed to state publicly any stock picks, and that anything that Kim has to say, any stock that she touts, is her suggestion and her suggestion alone. Now, having said that, Kim, you have made 8 picks so far. You are standing at roughly 50%. As of the close on Friday, 4 of your selections are higher, with your first choice Xilinx leading the way with a gain of 25% since you suggested it. And you have 4 that are lower, with your second choice VFC posting the largest loss, down nearly 19%. Overall, I'll call your around the table portfolio is up just about 6.5%. And that's up 3% from the week before. So what is your stock pick this week?
Sure. And I have my own caveat. All this is for your information only. It is not a suggestion of what to do. But the stock that I'm going to add is a software stock that helps companies that design semiconductors design them. And the company name is called Synopsys. That's SNPS. And why do we like it? Well, if you've been listening to the news, you know that we have a semiconductor shortage in just about everything. Companies are going to have to continue to build out their fab plants, but they're also going to have to redesign and keep designing for smaller, better, faster, cheaper chips. That's just the way technology works. Synopsys is one of the products, or a company that has products that can make that happen. It's a very nerdy kind of company, relatively, not a new company at all. It's probably not one you've heard of, has a pretty good balance sheet. and seems to be satisfying its customers, which are the chip makers and chip designers. So Synopsys.
All right, Kim, we will add Synopsys to our list and make that the 9th stock that you've chosen for us. Thank you. And I also want to thank Frank and Shana and Michael for being part of our panelists today. And also I want to thank you for watching and joining me. And we hope that you join us again next for our next edition of Around the Table with Stacy Smith. Have a great day.